Good morning. Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call is entitled Qualified Mortgages. CFPB seeks comment on reshaping residential mortgage underwriting. My name is Larry Platt, and I'm a partner in Mayor Brown's Washington, D.C. office and a member of the Financial Services Regulatory and Enforcement Practice. I concentrate my practice on a range of matters related to real estate finance, mortgage banking, and consumer finance in both the primary and secondary markets. First, I want to start with a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or forward it to your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not have a Q&A session, please send your questions regarding today's topic by email to GFM, that stands for Global Financial Markets, GFM, at mayorbrown.com, and we will respond promptly. This is the same email address on your invitation email. Joining me today is my colleague, Kully. Kris also is a partner in Mayor Brown's Washington, D.C. office and a member of the Financial Services and Regulatory Enforcement Group. She concentrates her practice on federal and state regulatory compliance matters affecting providers of consumer financial products and services. And with those brief introductions, we'll now begin today's discussion. Kris is going to start it off. Take it away, Kris.
Hi, everyone. Let's start with a level set. Remember that the Dodd-Frank Act included in its 2010 enactment a requirement that a creditor make a good faith, reasonable determination of a borrower's ability to repay a loan before making the loan, and without regard to the borrower's equity in the property. It was designed to address the concerns about the irresponsible home loan lending that was plentiful before the last financial crisis commenced around 2008. Such perceived abuses, either in isolation or collectively, as no-doc loans, risky, non-traditional loan products like negative amortization, and reliance on LTV as the primary determinant of creditworthiness. A violation of these so-called ATR, ability to repay ATR provisions, may result in the potential award of substantial money damages and authorize borrowers to assert against a subsequent holder of the loan a counterclaim for an original creditor's ATR violation if the subsequent holder sought to foreclose on a borrower in default. By statute and regulation, certain loans are deemed in advance to comply with these ATR requirements, and we're going to talk about a recently proposed revised regulation by the Consumer Financial Protection Bureau pertaining to this exception. Now, to get to the point, the CFPB is moving forward with its plans to discontinue the so-called GSE patch and to revise its definition for general qualified mortgages. The CFPB issued a proposed rule on June 22nd and published it in the Federal Register last Friday, July 10th. That proposed rule follows a prior advance notice of proposed rulemaking and other outreach and requests for comments by the CFPB, indicating the agency's intention to allow the GSE patch to expire. The CFPB is up against a deadline, namely January 10th, 2021, when the CFPB issued regulations to implement the Dodd-Frank Act's ATR requirements for closed-end residential mortgages. It established a definition for a set of loans, qualified mortgages or QMs, that would be deemed to comply with that rule. QMs are loans that meet certain requirements for loan types or features that have limited points or fees and for which the borrower's debt-to-income ratio DTI does not exceed 43%. For those QM loans, lenders must calculate the DTI and must verify and document a borrower's income and debts in accordance with the largely outdated set of rules called Appendix Q. In addition, the CFPB back then had established a temporary set of loans that would be deemed to be QMs and would receive that compliance certainty. That temporary QM category, for our purposes today, covers any loan that is eligible to be purchased by Fannie Mae or Freddie Mac, the GSEs. Since the GSEs will, under certain circumstances, purchase loans with a DTI that exceeds 43%, and the GSEs have their own income and debt verification standards apart from Appendix Q, there has been a set of loans that are covered by QM protection due solely to this GSE-eligible QM category, in other words, the GSE patch. In hopes that the mortgage markets would stabilize, private capital would return over time, the CFPB mandated that this GSE patch would cover those loans only for 5 years until January 2021, or until Fannie Mae or Freddie Mac emerge from conservatorship, whichever were to occur first. So staring down that January deadline, there's been a lot of discussion about that set of GSE patch loans, those with a DTI that exceeds 43% or that do not match Appendix Q. The patch continues to represent a large and persistent share of originations in the conforming mortgage market. If those loans were not QMs and they were not covered by this temporary patch, would lenders make those loans? If so, at what cost to the borrower? Perhaps only under a government program like FHA, or would lenders simply not make those loans at all? The CFPB asserts that a robust non-QM market has not materialized. So what will happen to those borrowers? And are those outcomes good? Are they welcome outcomes, or are those bad, detrimental outcomes that we want to avoid? The CFPB has said that it's concerned that allowing that patch to expire without changes to the existing general QM definition would significantly reduce the size of the QM market and could significantly reduce access to responsible, affordable credit. Accordingly, the CFPB is proposing to make some revisions to the general QM parameters. One fairly significant point of contention with the current general QM parameters is that 43% DTI limitation. Many experts have argued that DTI is not the best indicator of a borrower's ability to repay a mortgage loan. It has an adverse impact on low to moderate income and minority homeowners. Measuring income, particularly in accordance with Appendix Q, is burdensome and complex, and in any case, 43 might not be the right number. There are certainly some creditworthy borrowers that exceed 43% DTI. Those are the arguments against relying on DTI. And the CFPB in this latest proposal seeks to follow that reasoning and has proposed to eliminate DTI as a criterion for defining QMs going forward. Although, as Larry will discuss in just a moment, a lender would still be required to consider DTI or residual income in order to originate a compliant QM loan. So the CFPB is proposing to eliminate DTI and also to eliminate the requirement to follow Appendix Q. Instead, the CFPB proposes to distinguish QMs, which are deemed to comply with the ability to repay rule, from non-QMs, which do not get the benefit of that compliance label, by relying on the loan's pricing. Under the proposal, a first lien loan would be a non-QM if the APR, the annual percentage rate, were to exceed the average prime offer rate, APOR, by 2 percentage points or more. The APR threshold would be higher for smaller loans, generally those under about $110,000 for now, or for subordinate lien loans. But by using this pricing threshold, the CFPB asserts that a loan's price, actually its rate spread, is strongly correlated with loan performance and as such is a strong indicator of a consumer's ability to repay. While other metrics may also be correlated with ability to repay, the CFPB is proposing that APR spread is a reliably strong indicator of early payment distress and has the benefit of being clear and objective. In reaching this conclusion, it rejected proposals from some trade associations and consumer advocacy groups to keep a DTI test, although higher than 43%, and authorized reliance on compensating factors to go even farther up the DTI ladder. The proposal specifically asks for comment on its choice to reject that alternative approach. The proposal would continue to distinguish QMs that receive a safe harbor of compliance from those QMs that receive a rebuttable presumption of compliance, depending on whether the QM's APR exceeds the APOR by 1.5 percentage points as of the date the interest rate is set. That's the level for first lien loans. For both of these rate spread determinations, first to determine whether a loan would be a QM using the 2 percentage point rate spread, and second to determine whether a loan would receive a safe harbor versus a rebuttable presumption of compliance using that 1.5 percentage point spread. For both of those determinations, the CFPB is proposing that the lender would use the APR in effect at the time the rate is set. However, the CFPB is proposing a special rule for those purposes that would apply to loans for which the interest rate may or will adjust within the first 5 years after the date on which the first regular periodic payment will be due. So for those loans, which includes short reset ARM loans like a 3-1 hybrid ARM or even a 5-1 ARM if the rate can adjust on that 60th payment, the lender would use the APR that represents the maximum interest rate that may apply during that 5-year period. The CFPB proposes that this special rule for determining which APR to use for QM purposes is needed for loans with a heightened risk of becoming unaffordable relatively soon after consummation. The CFPB proposes that a QM would still need to meet the product feature limitations and the 3% limit on points and fees. In addition, a lender would still be required to consider and verify the consumer's income or assets and debt obligations and would have to consider the consumer's DTI ratio or residual income. While the CFPB proposes to remove the instructions in Appendix Q, the agency still expects lenders to verify the consumer's current or reasonably expected income or assets other than the value of the dwelling, and the consumer's current debt obligations, alimony, and child support using reasonably reliable third-party records. For that purpose, the CFPB proposes to provide a safe harbor to lenders that use verification standards that the CFPB would specify. For instance, the CFPB suggested that it could provide that lenders have complied with the requirement to verify income and assets if the lender relies on relevant provisions from the GSE's guides or from the handbooks of FHA or VA or USDA, or the CFPB could provide that lenders could pick and choose provisions from among those or other standards for that purpose. Lenders would not have to rely on the standards the CFPB prescribes. They could use other reasonable or innovative methods, but they would receive a safe harbor of compliance with the rule's verification standard if they use the specified standards. In the proposal, the CFPB also encourages stakeholders to develop additional verification standards that the Bureau could incorporate into the safe harbor set forth in the proposed commentary. Stakeholder standards could also incorporate, in whole or in part, any standards that the Bureau specifies as providing a safe harbor, including mixing and matching these standards. The Bureau thus welcomes the submission of stakeholder-developed verification standards and would review any such standards for potential inclusion in the safe harbor. This may give an opening to groups like the Structured Finance Association, whose comment letter last year suggested the creation of an SRO, a self-regulatory organization, to help such standards in the future. In addition, the CFPB points out that creditors would have the flexibility under this proposal to adjust their verification methods in the event of an emergency, such as the COVID-19 pandemic that affects consumers' incomes. The CFPB does not really address all the ambiguities that have arisen in implementing the ability to repay rule, particularly as it relates to verifying or documenting personal income of self-employed or other borrowers based on their business bank statements. Of course, the proposal could solve some of the ambiguities in underwriting self-employed borrowers if it specifies certain industry standards like those of Fannie or Freddie or FHA for verifying borrower income. However, the CFPB does propose to add some commentary language clarifying that a lender does not meet its obligation to verify income for QMs or non-QMs merely by observing an inflow of funds into the consumer's bank account without confirming that the funds are income as opposed to, say, proceeds from the disbursement of a loan. The CFPB does not, however, propose to set any requirements for analyzing bank deposits or for what type of justification is sufficient. For example, the CFPB did not add any proposed commentary to address the number of business bank statements a lender should use or the reliance on a fixed expense ratio to help determine business profitability that could then translate into personal income. So the CFPB didn't take advantage of this rule to propose any clarifications there. We should add that in May of this year, Fannie Mae and Freddie Mac issued guidance requiring that for self-employed borrowers, lenders must analyze a profit and loss statement and tax returns, transcripts, and in some cases bank statements. Then the lender must consider the extent to which the coronavirus has affected the borrower's business operations. For instance, a lender needs to consider whether the business is still subject to a government shutdown order or whether the virus has affected demand for the borrower's goods or services, supply chain disruptions, etc. Those requirements for Fannie and Freddie loans to self-employed borrowers are in effect until further notice. With that, I'm going to turn it over to Larry to discuss some other aspects of the proposal. Larry?
Thanks, Kris. So, determining the amount and sufficiency of personal income is at the heart of the verify and consider requirement. Kris discussed the verification side of the equation, which really is just loan processing. I want to talk about the Bureau's approach in the new proposal to decline to prescribe safe harbor specific underwriting requirements to qualify for a QM loan. So I think it's useful to return for a moment to the original language of the ability to repay requirements in the Dodd-Frank Act. Many forget or perhaps never even realize that Congress didn't include a specific underwriting requirement in the statutory definition of a QM loan. As Kris noted, it prescribed a cap on points and fees, a restriction on non-traditional loan products, and a requirement to document income and other assets. But rather than dictate an underwriting requirement, Congress instead simply granted broad discretionary authority to the CFPB to promulgate regulations regarding underwriting elements, such as the DTI ratio. And the Bureau exercised this authority when it created the GSE patch and the alternative 43% DTI limitation, and now it's returning to the roots of the original legislation. So the proposal, as Kris noted, would obligate a creditor for a QM loan to consider the consumer's income or assets, debt obligations, alimony, child support, monthly debt-to-income ratios, or residual income, but based on what's been verified. But it doesn't tell you how to evaluate these data points. So this empowers a creditor to set its own underwriting standards, and it requires the creditor to document the loan file, evidencing the creditor's application of its own underwriting standards. In other words, show your work. So let's take, for example, a creditor whose underwriting standards combine a loan-to-value ratio test with a DTI test. The lower the LTV ratio, the higher the permitted DTI ratio. And that would be subject to a cap that can be exceeded only based on the presence of compensating factors. A borrower who wanted to challenge whether the loan in fact was a QM loan couldn't challenge the propriety of the methodology, only whether the creditor actually applied its stated methodology. So for example, LTV, loan-to-value ratio, is not an indication of a borrower's ability to repay. It might go to willingness to repay or the likelihood and severity of loss, but it's not a relevant factor for ability to repay, but here it's used. Compensating factors, for example, reasonable people could differ on the relative merits of those, but nobody could challenge that. As long as the creditor included its documentation of its own application or of its application to its own underwriting requirements in the file, end inquiry. So you can see how that's like a more objective approach because the borrower can't challenge the underlying methodology. So do you think it makes sense? reasonable people might disagree, but here's the thinking. So many of the prior abuses during the last financial crisis were about verifying sufficiency and sustainability of income, not how that documented income actually was valuated. And at least in the AIM market, nobody really worries that the agency underwriting standards are irresponsible. People may take issue from various points from time to time, but generally speaking, I think there's a belief that they're prudent. And also, this type of approach dilutes the comparative advantage standards that the GSEs now enjoys because of the GSE patch, and thus may promote private securitizations. And that's been a big issue for the private securitization market, that they, aside from not really being able to compete on price because of cost of funds and the government guarantee, this comparative advantage, this structural comparative advantage built into the GSE patch has made it more difficult for non-conforming conventional lenders to produce QM loans without relying on 43% in Appendix Q. This approach also facilitates the development of private automated underwriting models, the contents of which could remain confidential. So you may have to show that the model includes things like DTI or residual income, but how it uses it is not required to be shown. They don't have to show their cards. And it also encourages the development, as Kris said, of these self-regulatory organizations to issue their own best practice standards that the industry may elect voluntarily to follow. I think one of the underlying premises, which may or may not be true, is that the riskier the underwriting standards are, the more likely investors will demand increased yield to compensate for assuming this increased risk. And thus risky loans, if the thinking is correct, might fall outside of the price parameters based on APOR. Now, if investors chase production instead of yield, which they do from time to time, this may not be true, but I think on balance that's the thinking. So there's a couple of spillover consequences that are worth highlighting based on the Bureau's approach. First is the so-called risk retention rules. Remember those, the skin in the game approach. So private mortgage securitizations are required to retain risk under the Dodd-Frank rules or statute and then the SEC rules. But qualified residential mortgages, QRM, not QM, are exempt from these risk retention rules. But interestingly, presently the regulatory definition of a QRM is based on the definition of a QM. So any change in the definition of a QM automatically will be incorporated into the definition of a QRM unless the relevant regulators revise the caps. So think about that, where there is no underwriting standard that's actually prescribed, and yet the whole concept of risk retention was to ensure that underwriters have skin in the game and so that they would produce responsible loans. A couple of weeks ago, the various regulators who must come together to revise the definition of a QRM announced that they would postpone until next June their consideration of any changes to QRM. So think that through. There's not an overlap of the regulators who define QM and QRM. QM is just the Bureau. QRM is a bunch of agencies, including the Bureau, like the banking agencies and SEC. So if the Bureau were to expedite the production of this rule, unless those other agencies were to follow suit, they may very well not be able to catch up with the Bureau, and any revision of QM would automatically apply in the QRM context. I think the other issue that I know we've been asked is, if the CFPB finalizes the proposal essentially as drafted, we think it could cause loans that now only fit in non-QM to fit within QM, and it could therefore depress non-QM production. Now, that's not surprising given the underlying premise of the Bureau that the non-QM market has not developed as robustly as it might have liked. Now, we know from our own work that there are lots of originators of non-QM loans and even more purchasers than there are non-QM loans. And while there's been some hiccups due to the COVID virus, the non-QM securitization market is very, very hot right now. So what happens if this rule goes into effect? Well, loans that exceed the point and fees limitation or use non-traditional loan products like Neg AM or interest-only loans would still be available only as non-QM loans. But if you have loans that are based on non-agency underwriting standards with DTIs in excess of 43%, those now may fit in a QM. So one good example of that is borrowers who have had a credit-related event like bankruptcy or foreclosure, and the GSE standards of how much time has to elapse before they're eligible for a new loan is greater than the standards that a private lender's own underwriting standards might apply. So let's just take an example. Let's say you have a self-employed borrower bank statement program using non-agency documentation standards. Does that fit in QM? Well, potentially yes, but given that a borrower always can challenge whether a loan is a QM loan, a borrower can challenge the sufficiency of the documentation and whether it violates the verify standard. So, for example, they can't challenge the consider as long as the loan file is properly documented, but they still can challenge the verify. So this requirement is no different whether it's a QM loan or a non-QM loan, but without a documentation safe harbor to satisfy the verify standard, like using agency standards, there's no objective certainty that a self-employed borrower bank statement program that does not rely on agency documentation standards will qualify as a QM loan. So how is that going to play out? Are people going to try to stuff it within QM and rely on the rating agencies or third-party reviewers to determine the sufficiency of the documentation standards? Remember, there's assignee liability if it's a non-QM loan. And so I think there'll be a lot of investor interest on this. So what do you think about this CFPB proposal? What are some of the key issues on which interested members of the public may want to comment? Kris, you want to talk about the pricing one?
Yeah, one that I'm interested in, the pricing distinguishing between QMs and non-QMs. I mean, is a loan's rate spread or the margin over an index, is that a good way to determine whether a loan is a QM? Is it a good proxy for a loan that the borrower has a reasonably likely ability to repay? Rate spread actually does not relate to the borrower's ability to repay at all. Commenters have argued to the CFPB that a loan's APR reflects a wide variety of factors unrelated to the borrower's credit quality, such as the value of the mortgage servicing rights or even the economy at large. So commenters have also argued that a loan's pricing is subject to determination by the lender largely, and thus a loan's QM status would, they argue, be vulnerable to lender manipulation. Others have argued that APR is a good proxy for credit risk, or at least a good proxy for loans that you don't have to worry about. In this regard, there has long been a view of some that as long as lenders are required to document a borrower's income, the ATR fix is not necessary in the A-quality credit market. Of course, since APOR is not static, the same loan could fall above or below the QM line at different times based on economic conditions without any changes in the borrower's credit profile. Larry, what do you think about some of the highlights of this rule?
Well, I think another one that we haven't really talked about yet is seasoning. So what about a borrower who is successful in actually making payments on a loan for a certain period of time? At least in hindsight, they've demonstrated their ability to repay the loan. And so I know some of the comment letters suggested the use of such an approach, that even if you don't think a loan is a QM up front, it can in effect morph into a QM loan by virtue of a positive payment history. Now that might be hard on a secondary market side because it's ultimately going to be priced on what it looks like up front, not what it might become, because that's so speculative. But nevertheless, if it's in your portfolio, it'd be nice to know that a borrower can't challenge the original creditor's determination of a borrower's ability to repay. So what's the thinking? Well, I think the idea is that it's taking a page from the GSE's representation and warranty framework and remedies framework. The first one started in 2013 and has been revised a few times, and the remedies framework, I think, was 2016, 2017. And together, what these frameworks do is provide that the GSEs will not demand repurchase of a loan for breach of loan level underwriting reps and warranties if a 36-month seasoning requirement without material delinquency is met. So the idea, again, is maybe there was a problem up front. We don't really know, but if it didn't manifest itself for 3 years, a borrower shouldn't be able to challenge, or the GSE shouldn't be able to challenge the quality of the underwriting several years later. Now, what the GSEs don't say that it isn't a breach of a rep and warranty, they say it is, but that in effect they elect not to exercise the remedy of repurchase that otherwise would be available here. And so here we're saying the same thing in effect. Maybe it wasn't a QM loan up front, but the remedy of the right to demand or the right to contest foreclosure shouldn't apply if it's 3 years later or whatever the time period is. So why didn't the Bureau propose to adopt an after-the-fact seasoning standard such that the loans can achieve QM status over the years? Well, basically they didn't say that they wouldn't. They just haven't done it yet. And what they've said is that they may consider adopting such an approach in the future. So it would be interesting in the comments on the proposed rule whether people want to really focus on that seasoning feature. So from a timing perspective, the CFPB proposes to extend the patch to expire upon the effective date of the final rule that amends the general QM loan definition, or if the GSEs exit conservatorship, whichever comes first. But note there's a technical defect in the proposal in terms of loans in the pipeline as of the effective date of the final rule. That has to be corrected. What happens to those loans? How are they characterized? Because it wouldn't be in connection with an application taken on or after the effective date. So the CFPB is requesting comments on all these proposals. In particular, it asks whether it should keep a DTI threshold, one that exceeds 43%, and keep it perhaps in tandem with a pricing threshold. So there's two proposed rules, technically. Comments are due on the proposed rule that sets the expiration timing of the patch on August 10th, and comments are due on the QM revisions on September 8th, 2020. One of the interesting things here is this timing, because we're going into an election year, or an election within 4 months, less than 4 months at this point. And so there's a 60-day comment period, and in theory, the Bureau could finalize a rule before the end of the year. So if Trump were to win re-election, it probably wouldn't change what the timing is. But if Trump were not to win re-election, it's possible the Bureau would want to finalize the rule before the existing director is no longer there. And even if that were to occur, there's some question whether the rule could still be effective because in the 6-month period between when it's declared final and it becomes effective, a new director could put a pause in its implementation, just like Director Kraninger did on the small dollar rule. So, this is just running right up to the election, and it'll be interesting to see. We do know that a lot of consumer groups support this concept that's embodied in this rule, and there already is a lot of consensus around it, although there's some disagreement. But we encourage you to submit comments on the rule, and if you want, we can help you with that. The best, most effective, and most persuasive comments are those that address the CFPB's goals of seeking to ensure that safe and affordable mortgage credit is available to creditworthy customers. But it's a data-driven agency, so to the extent you can provide data to support your arguments, that's a lot more effective. And then after considering the comments, the Bureau plans to issue a final rule, and as I said, it would become effective 6 months after the publication, pushing the patch until at least June of 2021 at the earliest, unless the GSEs emerge from conservatorship before then. Before we go, I would like Kris to talk about a recent decision about ATR that has gotten a lot of press recently. And so, Kris, do you want to take that one?
Sure. If our listeners will indulge us for a few more minutes, we do want to mention a recent decision relevant to complying with the ATR QM rule. We haven't had a lot of court opinions to guide us, but in short, the court strictly interpreted the rule's requirement to follow Appendix Q when making QMs, and in all cases, to rely on third-party documentation of income and not on any assertions by the borrower or, in this case, by the borrower's non-borrowing ex-spouse. So just a quick rundown. The Sixth Circuit reversed a lower court decision and found that the lender did not comply with the ATR rule because some of the borrower's income on which the lender relied was not based on reasonably reliable third-party documentation. The court indicated that the lender relied on assertions the borrower made about income that would come from the borrower's spouse under a separation agreement, but the lender didn't obtain the executed separation agreement, which had in fact not been executed at the time. And in the end, the parties to the agreement proceeded to divorce, which actually resulted in a much lower level of monthly income for the borrower. And the lender also relied on some prospective rental income without reviewing the actual lease. So the lower court had found that the lender made a reasonable determination and that it was not foreseeable that the parties would not abide by the terms of this purported separation agreement. However, the Sixth Circuit, the appeals court, reversed that decision. The court found that a TILA violation had occurred and sent the case back to the trial court for a decision on the damages. So just as a reminder, a borrower can bring a claim that the lender has violated TILA, which happened in this case, but actually the lender started a foreclosure action nearly at the same time. So at this point, the trial court will determine the amount of damages, and those damages will be a set-off to the foreclosure recovery of the lender. So again, the moral of this story, at least until the rule changes, strict compliance with those documentation requirements is required, particularly in the Sixth Circuit, but certainly in other circuits as well. So with that, Larry, I'll turn it to you to say goodbye to our listeners.
Yeah, and I also just add, I don't even know how strict you have to be. Here they relied on an oral confirmation of an unexecuted document that wouldn't be documented until after the loan was made. So you don't have to comply strictly with the requirements to know. That's kind of silly. So we don't think there's much to this case. It's been bandied about a lot as some big issue, but it really just says when you're supposed to verify, you're supposed to verify, period. So with that, I want to thank you all for tuning in. A few brief reminders. You'll receive an email with a link to the recording of our call today, and it'll also be available as a podcast on your preferred podcast platform. If you look at the podcast platform, don't confuse us with my comedian son, Tim Platt, who has his own podcast. Lastly, as mentioned before, if you have any questions related to today's content, please email them to GFM, Global Financial Markets, GFM@mayorbrown.com. Thank you again for your participation. Now you may all disconnect. Thank you.